And while the Fed's minutes offered no time frame on raising rates or further tapering its stimulus plans, it did show a spirited debate about the long-term unemployed and one economist's theory about that group's impact on the overall economy. Steve Leisman has more.
It's not every day that an economist's theories are seen as so important as to be discussed at the Federal Reserve. But the minutes of the Fed's April meeting released today show the ideas of Princeton professor Alan Krueger, President Obama's former top economic advisor, sparked a lengthy and lively discussion at the Fed, and they were rejected. In a recent research paper, Krueger argued that the 3.4 million of Americans who have been unemployed long term, that's 27 weeks or longer, are mostly not coming back to work.
The evidence suggests that the long-term unemployed exert relatively little pressure on the labor market, that many of them, sadly, give up searching for a job and eventually withdraw from the labor force.
As a result, the long-term unemployed do not help keep wages low, as the Fed believes. That means wages could rise fast as the economy picks up, fueling inflation, forcing the Fed to raise rates higher and faster than markets now think.
I think the longer people are unemployed, the more challenges they face. Employers are less likely to call them in for interviews. They grow discouraged. Their skills go obsolete. They become more isolated, more disengaged.
But minutes show, quote, a number of participants express skepticism about Krueger's work, citing other work that says both the long and short-term unemployed keep wages low. The Fed thinks that because wages didn't fall outright during the recession, there's little pressure for them to rise now. And with wage gains relatively muted, the Fed doesn't think it will face this problem anytime soon. But when the employment rate does get back towards normal, the Fed is going to have to make a call about whether Krueger's got it right. Told today his ideas were rejected at the Fed's meeting, Krueger responded, quote, I suppose that's better than being ignored, end quote. For Nightly Business Report, I'm Steve Leisman.
Mark Zandi joins us now with his analysis of the job market and those Fed minutes. He's chief economist at Moody's Analytics. So, Mark, let's talk a little bit about the job market, because in those minutes, the Fed officials said that one of the growth risks to the economic growth is a slack in the job market. What's your take on the job market? How's it doing?
It's improved, much improved. We're creating a couple 100,000 jobs per month, so that translates into 2.5 million jobs per year. And, you know, in most times that'd be considered pretty good. That's probably double the pace we need for a stable rate of unemployment. So at this pace, unemployment continues to decline. But that's the rub. The unemployment rate is still very high, well over 6%. There's still a lot of people that are out of the workforce that probably would like to be working, a lot of underemployed. So when you add it all up, the job market is much improved, but it has a long way to go before anyone will consider it to be healthy.
Do you agree with Alan Krueger that there's just a whole segment out there that have just given up and will not be able to return to this market? In other words, will we have to revise higher what we believe to be full employment in this economy now?
Yeah, I think so. In fact, I think most economists already have. So if you go back before the recession, I think most economists would have said, including folks at the Fed and the Congressional Budget Office, that the full unemployment rate was 5%. Right. And I think now the view is it's probably closer to 5.5%. We're still above that, but you know, it's much higher than it was. But the other thing I'd say, though, is that there's still a lot of people out there that are underemployed. So if you look at the number of people who are working part-time but say they want a full-time job, that's still very elevated. And you've got a lot of people that are not even looking for work, not counted as unemployed, but say they'd take a job if they could find one that was, you know, consistent with their skills and would pay a wage that would cover their commuting costs and other things. So I think there's still a lot of slack in the labor market.
Mm-hmm. So, Mark, what a lot of people are trying to figure out, whether you're an investor, whether you're a business owner, is what's going to happen with interest rates. When is the Fed going to begin this process of raising interest rates? We didn't seem to get any clues in today's report, but what can you tell us in terms of your predictions, reading between the lines, of when you think that's going to happen?
Well, you know, Susie, I think the Fed's actually pretty clear on this. You know, they each provide a forecast of where they think interest rates are headed. And if you look at kind of the middle part of the distribution of the forecast, you know, the average, they're pretty much telling us, and they've been saying this since the end of last year, that the quantitative easing process, that's the bond buying program, will end at the end of this year, and that by this time next year, so May, June, July of 2015, that's when short-term interest rates will start to rise. And I think that's something. They've been about as clear about that as they're about anything. And so I think that's the script that they're trying to stick to.
You think the markets are prepared for that? Let's recall what Ben Bernanke did last year about this time when he talked about the possibility of beginning the tapering process and interest rates skyrocketed at that point for that level.
Yeah.
Are we ready now?
Yeah, and Bill, that's exactly why I think the Fed became a lot more clear and transparent with regard to where they think interest rates are headed. It was that scare back this time last year when interest rates jumped when Chairman Bernanke started talking about tapering. So since that time, they've become much more transparent with regard to where they think interest rates are going to go. And I think the market is fully on board with that. And, the market reaction today was what it was because the Fed basically said in the minutes that, we're sticking to the script. Nothing has changed.
And that was very reassuring to the markets. Mark, thank you so much. Mark Zandi with Moody's Analytics.
Thank you.